Hello, everybody. My name is Bruce Montgomery, and this is my colleague, Tracy Priest.
Hello, everyone.
And we're with The Road to Retail. On our podcast, Tracy and I hope to offer insights and ideas for how emerging small and challenger CPG, consumer packaged goods, brands can establish and grow their business.
Bruce and I have been working in CPG commercial operations for over 30 years, working on brands of all sizes. By commercial operations, we mean all aspects involved in establishing and growing brands across channels and platforms. On our show, we bring on guests that are brand founders, leaders, investors, as well as all kinds of suppliers to these emerging brands that are subject matter experts to share their unique insights with the audience.
To keep up with the show, please follow the Road to Retail podcast on Apple Podcasts, Spotify, or YouTube. Leave us a review and consider sharing the show with a friend or colleague that may benefit from the content. You can also check out our website at www.road2retail.com and follow The Road to Retail on LinkedIn. Let's get to today's episode. Looking to scale or launch your supplement or skincare brand? Eagle Labs Incorporated, based in Florida, offers full-service NSF-certified contract manufacturing of capsules, tablets, powders, liquids, gummies, and lotions. All of their manufacturing takes place in the USA. From R&D and formulation to packaging and fulfillment, Eagle Labs provides scalable, high-quality production that meets FDA and NSF standards. To learn more, contact Michael Law, Chief Commercial Officer at Eagle Labs at michael.law@eaglelabsinc.com, EAGLELABSINC, Michael Law, eaglelabs.com, or text him at 203-242-6417. Today's Road to Retail episode is powered by Market Performance Group, MPG, a leading omnichannel commerce agency delivering integrated commercial solutions that accelerate profitable growth. MPG's new growth initiative helps brands of any size win in every channel, whether launching DTC, scaling on Amazon, or entering brick and mortar. Its team, veterans from top retailers, CPGs, and digital platforms, connects brands with consumers across the full funnel, delivering right-size strategies, strategic go-to-market plans, advanced analytics, and deep retailer relationships for exceptional business results. Check them out at marketperformancegroup.com. Hello, everybody, and welcome to the latest episode of The Road to Retail. There he is again, my good friend Tracy Priest. Tracy, how are you today?
I'm doing fantastic, Bruce, and I keep showing up every time you send me an invite to do this. And I'm going to keep doing it.
I know I keep trying to send them to your burner account, but you keep finding a way to get to the show. So excellent.
Excellent. So tell us who our guest today is. I'm excited about this episode.
Oh, we have returning champion from a couple of years ago, Andy Whitman, coming to us. Andy's with Loft Growth Partners, where he is a managing partner, and they're a very successful early stage investor in emerging brands. So Andy, welcome back to the show, and thank you for your time today.
Absolutely. Thanks for having me.
No problem. So before we jump into our topics, why don't you just tell the folks a little bit about you, your background, and how you got to your current position and what Loft does?
Sure. So I'm not a typical investor. I was an operator for a little less than 15 years, and now this year is 25 years in the investor and industry partner seat. So I started my career at what used to be General Foods. General Foods was a Dow 30 stock in a prior life. Bought Kraft, was smart enough, I think, to keep the Kraft name for the combined entity. Also bought Oscar Mayer and Nabisco and Cadbury, and now the entity is two businesses, Kraft Heinz and Mondelez, sort of snacks versus all other. Anyway, so I started as a kid in marketing. I worked on Kool-Aid. It was a great place to learn how to run a business and be a marketer. And along little less than 15 years, I had a very sort of non-traditional career path. Most people in brand management move up the ranks, become a VP, become a general manager, and that's where almost all of the large company CPG CEOs have come from. I sort of did a little bit of a detour, did a position that was more operations than other things. I mean, technically, it was still a marketing seat, but the keys to success were more operations. And I did a couple rotations through sort of a corporate assignments. And worked on big businesses, small businesses, lots of things, including having been involved in some acquisitions. Anyway, I had a bunch of observations. The two most notable ones were we were really good at a long, long, long list of things, but we were not good at two things. We didn't have a lot of patience. And while we were great at new products, we weren't as good at 0 to 100 million as we were at 100 million to a billion. Not because we weren't great, but because of the patience thing. And what I learned through some interactions that I had with other multinationals um, was they were very similar, really good at a lot of things, not a lot of patience, better at 100 million to a billion than 0 to 100 million, especially if it took some incubation time. So I also got a chance to get to know, I think, the three marquee consumer investors at the time. Keep in mind, this is a lot of years ago. Um, Catterton, which is still around, Swander Pace, which is still around, and the Shansby Group, which is now TSG Consumer Partners when Gary Shansby retired. Three great firms and a lot of spinoffs that have come from those great firms. But also, they couldn't write small checks, even with much smaller funds that they had 25 and 30 years ago. They still couldn't write small checks. So nobody was really helping the emerging brands. So there needed to be a farm system, to use a baseball analogy, for large multinational CPGs, and there needed to be a farm system for the investor community. So why not me? And that's sort of how this transpired. This year, as I mentioned, is 25 years for Loft and our predecessor entity, same thing, just better name. So anyway, that's what we're doing. That's where we are. That's how I fit into all this chaos. And I have a personal passion of helping the entrepreneurial ecosystem. So whether it's workshops with people like Gary Hirschberg, the founder of Stonyfield Farms, or Bob Burke, or many other people in the industry, I'll spend the better part, if you do the math, of a business month a year um, just on pro bono helping of entrepreneurs. So it's a personal passion for me, and I'm glad to do it and glad to be here to help with Road to Retail.
Well, thanks, Andy. So wait a minute, very important question. So you were the guy responsible for the giant jug of Kool-Aid busting through the wall?
Well, I didn't create it, but I did have the privilege to work on that business a couple of times over many years. And I do have some Kool-Aid paraphernalia that my daughter has repossessed.
Many years ago, a kid came to our door on Halloween dressed as the Kool-Aid man, and I was like, your parents must have made that because there's no way a little kid like you knows what that is.
Yeah, I think that's fair.
That's very true. Very true.
Tracy, take us.
Absolutely. So tell us a little bit, Andy, about Loft Growth Partners and what they do and how you've touched on it a little bit, but about how they help small emerging brands.
Yeah, so the best way to think about us is not a traditional investor, despite that's, SEC regulated and that's my day job. We're really industry help that happens to come with a bucket of cash. It's very informal, it's very euphemistic, but that's sort of the summary of what we do. There's plenty of investors that are just investors, and there are plenty of people that are value add investors. We're sort of at the further end of the spectrum of real industry help and, oh, by the way, some capital. You can see behind me, some of the brands, just a small smattering of the ones that we're currently partnered with. But again, we have a very small number of partner companies. That's what we call our investments or portfolio partner companies, because that's a reflection of how we work with them. So We've never had more than 10. I think we have seven or eight at the moment. And that's typical of how we can be really helpful to companies because of a very, very small number of them.
That's
Great.
awesome.
So Andy, when we had our prep call for you coming on the show, we talked about with Expo West coming up, you had a very unique take on how an emerging brand should kind of prepare and think about having an impactful show. So why don't you tell the folks what you mean by that?
Yeah, I mean, remember, I come from the perspective of an operator and an investor and industry partner. And if you don't manage a show, it will manage you, especially a show as big as Expo West.
Yeah,
Uh, I've been to going to Expo West. Well, I had hair when I first went.
me
So
too.
that was a really long time ago. It's a great show, but it is a massive show. It's one of the few growing shows. Trade shows is a crummy industry, I think. And most of the trade shows are declining rapidly. This one is growing rapidly. And it's several times the size of the first time I went, which was, I don't know, 30 something years ago. Um, anyway, so if you don't manage it, it'll manage you. So everybody has a different perspective of what they want out of the show. Most of the emerging brands are interested in retail distribution. So let's stick with that one. That's a logical one. But if all you do is wait for people to come by the booth, again, it's managing you. If you want to manage it, you got to work it really hard. You got to reach out to all the buyers, the ones that you have distribution at and the ones you're seeking, the distributors, the broker community. Work it really hard and see if you can get time slots. Know that the vast majority of them will not give you a specific time slot, but they will say, okay, I'm putting you on my list. I'll come by. I coined a phrase many years ago. For me, I create a shopping list. That's what I call it. And I have two versions of it. I have it sorted alphabetically, and I have it sorted by booth number. So these are the people I need to make sure to go hit. And the retailers have their version of it. You
Yep.
want to be on their equivalent of my shopping list. Um, so that's really important, but you got to work it hard because it doesn't just happen. They don't just wander by. I mean, some of them will, but work it hard, make it work for you. But think about what's the most important thing you want out of the show. Um, there are some people that retail distribution is a big part of it, but consumer activation is a bigger one, or they want to try and find five marketing partners for next year. Know what you want out of the show and go attack it. And let me be clear, there will be tons of packaging and raw material suppliers, and there will be tons of marketing vendors trying to pitch their wares. By the way, that stuff can be awesome. But if you let it manage you, it'll take over your show and you'll get stuck in a whole bunch of 15-minute conversations. I strongly recommend you print up a bunch of business cards that say, marketing at mybrand.com or operations at mybrand.com or raw materials at mybrand.com. And you give it out saying, hey, I'd love to learn more about it. Today's not the time. Here's a card. Email us at this address and get out of that discussion in 15 seconds if that's not what you want. Because you want to make yourself focused on whatever it is you're trying to achieve. And again, you need to manage your show. And while it's probably late for Expo because everybody's booked their travel, it's shocking to me how many people, founders included, leave after the first day or day and a half. Retailers are coming by the afternoon of the last day. Marketing partners and investors are coming by the last afternoon of the last day. If you're not there, what does that say? And when booths are either empty or there's nobody there but the most junior person, you know, that doesn't say a lot. So, by the way, I mentioned investors might come by. If that's a really critical thing for you, most of the investors in the space will be there. But just like the retailers, you got to work it hard, set up meetings, and ideally set up those meetings off show hours. I won't speak for anybody else, but I'm up before the rooster. So if somebody wants to come see me at 6 or 6:30 or 7, maybe great. Most people are not seeing people at 6 o'clock, but most people are seeing people at 7 or 7:30 or 8. So, work it hard off show hours. And if the only time that works is during the show, fine. But it's a distraction from seeing retailers or whatever else. So again, I've said enough, but don't let the show manage you. And this applies to Fancy Food Show and IDDBA and Global Pet Expo and whatever else the Beauty Connects, figure out what you want out of the show and work it hard.
Love
That's
what you said,
great.
Andy.
So
Yeah.
folks, a couple of other things. Tracy and I just dropped episode 141, which was our take on how to attend a trade show. So please couple that with the counsel Andy's giving. Andy, before we bounce it to Tracy on the next topic, again, during our prep call, you made a really interesting comment around the difference between a horizontal show and a vertical show. Can you just
Yeah.
tell the folks what you mean by that? I thought that was really cool.
Sure. Many people will go to too many shows, and some people will only go to one show. So there's three kinds, in my opinion. And Tracy talked at length on the episode you referenced about selling shows versus non-selling shows. My preference is everything turns into a selling show because the reason you're there is to sell. But the reality is something like a UNFI tabletop is 100% a selling show,
Yep.
where others are questionable. So there's the pure selling shows, and then there's what I call the horizontal shows versus the vertical shows. Horizontal shows are things like Expo, where they are all categories, all channels, all everything. Now, granted, it has a bent towards better for you, but lots of categories, lots of channels, e-tailers will be there, retailers will be there, you name it. Horizontal shows are things like IDDBA, which, if people aren't familiar with, is the Dairy, Deli, Bakery
Agree. Yeah.
Association show.
Yeah.
So that is a very narrow slice of the grocery store world. And it's not massively attended, but everybody that matters in those categories, manufacturers and retailers, are there. So something like an expo is amazing, but something like that, the bakery deli show is great. The pet show, there are two of them a year, one in Vegas in August, which I don't know what the hell we're thinking about when it's 110 in the shade.
Nope.
Or Orlando, which is the Global Pet Expo, which is 2 or 3 weeks after Anaheim every year. Going to a vertical show like a pet show or like a dairy show is really valuable in addition to the horizontal shows. So keep that in mind.
Yeah. Andy, I love
Right.
the best advice you gave. You gave a lot of good advice, but the one I want our audience to know is know what your strategy is going into the show. Don't just
Yeah.
show up without a strategy, number one. And hats off to Expo West because now they've learned how brands get inundated with people selling ingredients, packaging, and they
Right.
have select hours now, buyers only, which I
Yeah,
think
I
is
lobbied for
awesome.
that for several years. And honestly, I wish they'd do more of it. I wish it was a half a day, not an hour or hour and a half. I'm still lobbying for that. So if they're listening, I'm still lobbying. But I think half a day each day for buyers only, or
Yeah.
maybe 2 hours, I think that'd be valuable.
So
Yeah, I totally agree.
one other thing, folks. Sorry, Tracy, before we kick it to Tracy for the next topic, Andy reiterated something. Tracy and I have talked about it. We have had other guests such as Scott Emerson say the same thing. These trade shows, one, they're expensive, right? They're an expense in terms of the money out of your pocket, the time your staff is there, making a booth, whether you have something that looks like Walt Disney Company made it, or if you have a table with skirting and three posters that look like your 12-year-old daughter made them. It's still an expense, okay? And I cannot tell you, when I've been responsible for these shows, what Andy said is so true. There are people there from the opening bell till the closing bell. And if you leave early to try to catch one flight early or to get to the warm beer and stale, chicken nuggets at the reception, you're doing yourself a disservice because you should really be in there. And as also as Andy said, don't leave your most junior person there, right? Because sometimes the retailers come right at the very end because they're not going to be tackled. And if half the booths are empty, your chances go way up just because you're still working. So
Yeah. I
keep
think well
that in
said.
mind. Tracy?
Yep.
Absolutely. So let's talk about what's going on in the market today, Andy. So tell us a little bit about what is the conditions of the market right now, buying and selling. What are you seeing in the market?
Well, um, let's take a quick view on the first, what is it, 7 weeks of the year.
Mhm.
And I scribbled down in 3 minutes before we got together here today a short list. Um, some are investments, some of which are acquisitions, but these are high profile ones. I'll mention things like Good Culture got an investment from L Catterton, Manitree, and Semcap. Wonder Belly was acquired by Procter and Gamble. Good Crisp did a acquisition or was acquired by a private equity firm, M. Pearl Rock. A dog food company called Ollie was acquired by a family-owned Spanish business. Purell was acquired by Clorox. Bachan's, if I'm pronouncing that right, is acquired by Marzetti's. Trubar was acquired by a Turkish snack company. And well, I'll make a comment about it in a minute. Once Upon a Farm did an IPO. So those were 8 in 7 weeks. Now, those are the high profile ones. That's a lot right out
Hmm.
of the chute. And I'm sure I didn't think of that a bunch. Um, I think some people would say, hey, M&A is back. Great. And by the way, that's a really good start to the year. Some of those are ones that probably wanted to happen last year and just spilled over. But either way, that's a lot of high profile activity. Interestingly, two of those are family owned foreign buyers. That's an interesting thing. Let me make a really quick comment about the IPO. John Foraker, who is the CEO and a co-founder on Once Upon a Farm, is a phenomenal person, an amazing operator, and a rare breed. Most CPG companies don't and shouldn't go public. So when I see entrepreneurs talking about possible exits, acquire by, Kraft Heinz or IPO, I always laugh at the IPO. If you're really huge or you are a rare breed like a John Foraker, maybe. But think about it this way. If you're $200 million in revenue, which is on the big side for a lot of these emerging brands, and maybe you're 10% EBITDA, because that's math I can do in my head, and you're non-seasonal, so that you're 5 million of EBITDA per quarter. If you have one commodity issue or one executive severance or one retailer distribution hit, delistment or something, you're totally screwed for the quarter and you're in public company jail. So you got to be much bigger in most cases. So long story, don't think about IPOs, but it's awesome to see John and the Once Upon a Farm team get theirs done, and it's done really well since the IPO. So you asked the question, what's the market like? I think the best way to think about it is actually kind of how we talked to our partner companies and our investor base um, when we had our annual meeting. Um, the headline is there is tremendous appetite for on trend, well executing, profitable, high growth winners. Now, that was quite a mouthful. And the brands with lots of asterisks, meaningful complexities, they're either not getting stuff done or they're getting stuff done in sort of non-traditional way. So what do I mean? Um, what drives the interest? Growth, velocity, repeat rates if you're doing online, margins or margin path, omnichannel scale, whatever it is, and most importantly, strategic fit. Those are the kinds of things that makes um, somebody like a Good Crisp or somebody like a Wonder Belly get acquired because they check a lot of boxes. The reality is, most emerging brands don't. They had a snafu on this, they had a margin problem on that, they have channel concentration. They have whatever the business is that creates complexity. Those asterisks, as I sometimes call them, lead to, unfortunately, businesses either not getting funding at a much lower valuation, or such, or if it's sort of acquisition related, they lead to people not buying or buying at a low price or what sometimes are called structured outcomes, which, for an entrepreneur, unfortunately, is not good. It basically means they're bought for either very little or nothing with a shot at earnouts or something over time. So, while I don't want to be negative, I think it's important to understand the days of okay but not great businesses raising a ton of money or selling at 4 or 6 times revenue. That just doesn't happen. And by the way, it only happened for a few years, maybe 5 or 7. It was an aberration of multinationals buying teeny businesses. Before that, they were buying 100 and $200 million brands. And after that, currently, there are exceptions to every rule, but they're back to buying businesses with a little bit of scale. So, with all that said, there's tremendous appetite from the multinationals, from the strategics. There's tremendous appetite for the 2 to $500 million, maybe private equity backed, um, smaller strategics. There's tons of appetite and tons of dry powder from the investor community. But as a broad overstatement, the asterisks create challenges, unfortunately. So again, not meaning to be negative, but it creates the sense of urgency to get rid of the asterisks.
No,
And check as many boxes as you can.
yeah, that
Yeah,
makes
I think
sense.
that's right.
When we had you're saying the same things. We had Nick McCoy, who is an acquaintance of yours.
Yeah.
He was on the show and he said the same thing. A while ago, brands could get a lot of attention in that 20 to 40 million range, and now they want to see a path to 100.
Yeah,
Easy.
I mean, there are lots of exceptions. I mean, ConAgra bought a bad business called Fatties, which I don't know the exact revenue, but I think it was probably closer to 30 or 40 than it was 100. There are plenty of exceptions. But when you see entrepreneurs that have a $2 million revenue business and are excited about getting acquired in a year or 2 or 3, um, it's hard to believe that they're going to get to the scale that matters in that time frame. It doesn't mean it isn't possible. It's just, acknowledging the realities are important. And part of that reality is it takes more capital to get to the promised land now than it did a few years ago because the destination is further away.
Isn't that the truth?
Yeah.
So
So
Andy,
again, I don't want to discourage people, but deal flow is immense. Desire and appetite is immense, but you got to be at the right place and have the right fit for the right situation.
and you have to
Sure.
be tight, which we're going to get to here in a second.
Yeah.
So, Andy, as we push a little bit into the nuts and bolts of what an investor such as yourself is looking for in an emerging brand, I want to tell the folks that in Andy's first appearance in episode 60, you can go back and kind of refresh if Andy doesn't feel like going quite so deep here. But, Andy, all the deals that hit your desk and those of your colleagues, what are the three or four like big filters that you're looking for? Or what do you hear from your investors, the people that trust Loft with their money? If they're like, hey, Andy, we work with you guys because you're really good at X. Like, how do you thin the herd? Who gets a phone call or at least a returned email saying, that's interesting?
I mean, I think whether you're dealing with a pre-revenue idea or an investor like us, or let me do it in order, a pre-revenue idea, an angel investor, somebody like us, somebody much bigger that writes much larger checks like the Cattertons or others that I mentioned earlier, whether you're dealing with Kraft or P&G, I think that was 5 or 6 examples, um, are all looking for the same thing. And what they're looking for is a reason to believe. The 3 simple ideas, 3 simple words, reason to believe. Now, everybody's definition of what reason to believe is going to be different. So I have referenced this before, and I'll say it again. I think the reason to believe for me, and I think for most investors in this space, is sort of 5 very simple things. First and foremost, um, what is it about the brand and the category? And by the way, there's something archived called 5 Things to Say to Investors at the resource section on the loftgrowthpartners.com site. So number one is say something about the brand and category. If you are lucky enough to be able to say we have a really differentiated approach in a large and growing category, that's probably the optimal thing to say. Number two is you're getting some traction. So you want to say, and again, everybody's definition of what reason to believe is going to be different, but we're doing well in the market, or we're getting ready to enter the market, or we've achieved these milestones in getting ready to market, or, we're outperforming our competitors based on these 3 things. Here's the traction we're getting. So that's number two. Number three is some version of great expectations are coming. So we're just at the beginning of growth, profitability, margins, whatever it is you're going to say. So that's number three, great expectations. Number four, you got to say something about your team. And if you're the solo entrepreneur in the early stages, I'm the person to make this happen, or we're the team to make this happen. Something about the team. And you got to think about your audience. What's in it for them? So return potential, something about what's in it for them. So for me, it's 5 really simple thoughts, all of which people can access on the resource section of the loftgrowthpartners.com site. So that I think applies, those 5 principles apply whether you're talking to, your next door neighbor for a pre-revenue idea, or you're talking to Kraft or P&G or L'Oreal about possibly buying the business. I think the same 5 topics play. What you'd say is different based on which stage you're at.
Interesting. And folks, we will include the link to Loft Growth Partners website when we post this episode. So fear not. Tracy?
Absolutely. So you talked about from the investor side. So let's talk from the brand side. How does a brand know, and what do they need to think about before approaching an investor? What tells you that, hey, these guys are ready? And I know you just did the checklist, but that was more from an investor.
I think that's fair. And I think the most important thing is they should raise capital for the right reasons. Just because all the cool kids are doing it doesn't mean you should do it. And take that in the sort of facetious way I mean it. But I believe too many businesses raise too much capital too early, which is a weird thing for me to say given what my sort of current day job is. But I think entrepreneurs would be better off to bootstrap things a little further. I've been saying this for years, and I know I've said this to both of you before, but seasoned entrepreneurs make mistakes First-time entrepreneurs definitely make mistakes. And the only thing I can 100% guarantee is most entrepreneurs are going to make some mistakes. And if they have too much money, they're expensive mistakes. And if they don't have a lot of money, they're cheap mistakes. So make your mistakes before you have too much money to spend. Um, and, you know, once you've gotten to understand what works, understand what drives your velocity if you're in retail, or what drives your repeat or subscription rate or return on ad sales or average order value or whatever your metric is online, figure that out before you start throwing a lot of money at things. Because I know a lot of brands that have blown through, two, five, 10, $20 million and don't have a lot to show for it. Where some of the ones that waited a little bit longer, yeah, maybe it was a little painful, but the entrepreneurs own a materially larger portion of their own business. And when they started deploying the capital, they knew what to do with it, not trying things.
Trial and error can be very expensive, can it?
It can be. So let's assume you're raising for the right reasons and you know what you're going to do with it. Understand as an entrepreneur what you're looking for. Um, if you're looking solely for a check and don't bother me, that is perfectly acceptable. And I applaud people that are focused enough and know enough about themselves to know what they want. That would not be right for us as an investor, but there are plenty of people that will write a check and talk to them once a year. That isn't us. And it isn't, I don't think, what most consumer entrepreneurs I see should want or do want, but I think it's a perfectly acceptable answer. So if you're one that wants some help, um, push yourself to make sure you really want help, because it's really obvious to somebody like me when somebody says they want the help, but nothing about their body language, their history, because it's a small industry, or anything says they really want help. Um, if you have an investor, whether you own 97% or you own 100% or you own 60%, the SEC rules are very clear. You have a fiduciary obligation to outsiders above yourself. Um, so just because you control things doesn't really mean you're in control. So just know what you're signing up for. And if you're looking for help, find people that can help with whatever your issues are. And remember, this is a two-way street. You're talking to investors the same way they're checking you out. So I think it's important for you to find the right one. I will, without mentioning names, there is a company I'm very close to that passed after a very long fundraising process, passed very late in the process on a fairly material check because they came to the conclusion that they and that investor weren't aligned on what were the success factors and what the priorities on the business were. And I applaud the entrepreneurs because it's really hard to pass on money when you've been looking for it for a while. And I think it was probably one of the best moves they made, because it would have been bad if they and this prospective investor were so misaligned.
Yeah, good
Yeah.
advice. Great advice.
So folks, Andy mentioned some things we've spoken of before with other guests. There are some people that will give you a check and leave you alone. Andy knows them. I don't. Most people I know, they're going to give you a check and they're probably going to check in sometimes with more frequency than you'd like. But you can, as Andy said, search for people that not only can give you, that can, help you with your funding, but also have some expertise or access, whether it's how do I work with Amazon? Do you know anyone at Walmart? Can you introduce me? Look for that value add where you can. So Andy, one other thing here, what should a company, once they've made the decision to raise money for the right reason, and you already referenced, sometimes you'll find the people that leave you alone, But what does the entrepreneur really need to understand once they take that money? You said a key thing a moment ago, alignment, right? We've had some other guests on and they've talked, we've said like, what's the biggest mistake you made raising money? And it's like alignment. My investor
Yeah.
wanted to be out in 3 years, and this was going to be a 7 year pull, so there was a lot of tension there. We've also talked about alignment because other people have told us that most investors are going to give you your money, they're going to check in, but they want it back plus a return in a period of time. They're not here to invest unless probably they're related to you for you to build the company to turn over to your children. They're lending you money. So what should people be thinking about, whether it's reporting, reiterating the importance of alignment? Once Bruce takes that check, what happens?
Yeah, I mean, Bruce has got to be clear on, if you have an expectation, Bruce, of the business growing at this pace, and the investor has an expectation of it growing at a much faster pace, and the investor has an expectation of it being profitable immediately, and you have an expectation of 24 months, there's going to be a lot of tension in those phone calls.
Mm.
So we talked enough about alignment, but you need to go down into some granular detail. Um, Time horizon is an important one. Um, is this something that the investor is expecting a 3 year turn on, a 5 year turn on, a 7 to 10 year turn on? Who knows? But having some clarity around what the time horizon is, in general, I'll be honest, I find entrepreneurs often have a shorter time horizon than I do because um, they only are thinking about everything going perfectly.
Mm.
Yeah.
Um, but not always. I give credit to one of our entrepreneur founders that has no interest in going big in retail anytime soon. They believe, and I agree 100%, they are not ready for that. So this is a business that's more than 95% D2C plus Amazon. And they'll get to retail when they get to retail, but they're not ready for it. Nothing about the product or the packaging is optimized. Everything is optimized for e-commerce. So understanding time horizon is important. Understanding what decisions the investor expects to be involved in and or is contractually required to be involved in. Those could very well be two different topics. Um, but that's important to understand. If there's additional capital promised, how does that work? What triggers it? What are the requirements? You know, when things don't go well, how are the teams gonna operate? And by the way, nothing goes
Never,
according to plan. You
never.
can be 100% assured that the plan you developed is crap, and you'll either do better or worse. And by the way, unfortunately, the vast majority are underperforming the plan, not because they sold a pile of dung, it's because shit happens. And retailer decisions take longer than they ever have before, and they keep getting longer. Or, there's more meta algorithm changes in the last 24 months than in the 24 months before that. So just the world keeps shifting. So, it happens. So there's a lot of things that people need to be clear on before they raise, as they raise, as they go through it, and that's just when the hard work starts.
Yeah, and one last question on this, Andy, just for the
Yeah.
folks, is when they start to go through the process of raising money, and again, as you said, for let's assume for the right reasons,
Yep.
what info do they need to bring to the table, and how organized does that need to be? I mean, obviously, the more organized it is, it reflects better on you rather than showing up with a shoebox full of receipts and like two hand puppets and a Walmart deck,
Yeah.
so
Yeah, I mean, I think fundamentally there's just a small number of things. Um, Look, when you get to final phases, you're going to need all the material contracts in one simple place. And by the way, you should keep a folder, a Dropbox folder somewhere, a folder on your hard drive, something that has all that stuff. Because if you try and go compile it at the 11th hour, your head's going to explode. So just keep all the material contracts in one place, etc. But that's late in the process. The early part of it is you need a really short, simple one page, not 2 pages, not 5 pages, one page summary of what it is you do, why it's going to work. Think about those 5 points, make them on one simple page. Um, so you need to provide some simple basics. What the hell is your business? Is it a shampoo? Is it a food product? What the hell is it? Why is it special? Why is it different? Then you need a short deck. This is not a 75-page Word document. This is maybe 10 slides, maybe 15. If it has to be 20, I question that it's not focused enough, but some sort of a simple PowerPoint that you can share with people. Um, it's about why your business is special and interesting and different. And then you need an Excel. And this is not, by the way, don't ever, ever send somebody an Excel hard coded and then converted to PDF. Send them an Excel. And it's really simple. You need a whole lot of tabs. Think of it as here's your P&L tab, which is really your summary. Here's your cash tab, which is different from a P&L. And then think about all the lines of your P&L. Each line probably gets a tab. Here's your revenue buildup. Here's your doors, here's your SKUs, here's your turns per door per SKU, and it builds up to the revenue that then gets pulled into the summary tab. You need the same on your cost of goods. Just having, hey, our cost of goods is 70% of revenue isn't particularly interesting to learn about, but hey, here's my 5 SKUs and here's my cost of goods for the 5 SKUs. Or, if you're in, the dairy business and you've got fluid milk and you've got yogurt, they probably have very different margin structures. So maybe you've got your fluid milk and your yogurt separate, and it pulls in based on margins on those businesses by those two sectors. Again, pulls into your summary tab. And the same as you go down the P&L, what you're spending, what's your head count, and most of these businesses, including some of mine that have gotten to 100, 200, 300 million, you're not talking about hundreds and hundreds of people unless you have a manufacturing plant or a direct store delivery force, sales force. And both of those are fairly uncommon. So maybe you have 5 people, maybe you have 10 people, maybe you have 20 people. List them. And by the way, here's the 5 we're going to add over time. Maybe you don't want the person's name on it, so it's a title. Here's the salary. If they're a new hire, this is the month or the quarter they start in, and you can watch it populate. And here's all the details. Here's the head count. Here's the bonuses. Here's the benefits. Here's the taxes. Be thoughtful about all this. And again, it pulls into your summary. So the point of all this is, you need to see here's what your growth rate assumptions are. You know, Keep in mind, everybody is going to give your business some sort of a haircut. They're just going to be a little bit more conservative than you would be. So the question is, are they going to give you a 10% haircut or a 70% haircut?
Ooh.
And if it's a 70% haircut because they don't have a lot of confidence, you're probably done talking. So 3 things: a really, really short summary, a fairly short PowerPoint deck, ideally 10 pages, maybe it's 15 or 20, but it doesn't take a lot, because the goal of this and the Excel, the goal of this is not to get a check. The goal of this is to get another meeting, because
Right.
unfortunately, you don't meet once and get a check in the mail. There's a lot of discussion. So yeah, you need the material contracts and you need the employee census data and you need blah, 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 but that's for another day. So 3 simple things.
There we go.
Great.
Great advice. Bruce, was
Tracy?
there anything else before we head home?
No, I think Andy's given the folks a ton of great knowledge. So let's head into the absolute material question of the day here.
Oh,
Absolutely. The most important question of the day. What is your favorite sports team, band, or brand, and why do you support them?
well, I bleed a little red. I'm a Wisconsin Badger alumni, so I'm a Badger fanatic. Although I do live now in Colorado, so my daughter and I go to a lot of CU women's basketball games. Which, by the way, they've had an interesting season. They're not ranked, but they beat number 14 TCU and beat number 20 Texas Tech. So two interesting big wins against ranked Texas teams. But anyway, so the answer is my Badgers for sure.
Yeah, during COVID, we were supposed to go to the Wisconsin Notre Dame game at Lambeau. I think it's getting rescheduled at some point, hopefully, before the next millennium, but who knows?
Yeah, good luck on that.
Andy, I can see you and Coach Prime with the cowboy hat and the mirror shades on the sideline.
Oh yeah, just my style.
That'd be awesome. But hey, Andy, this has been fantastic. I really appreciate you coming on. The tips and counsel has been fantastic. Hopefully, you'll have a super successful Expo West. I know Tracy will be out there. But how can people contact you or learn more about Loft Growth Partners?
Sure. Well, as I said, loftgrowthpartners.com has more information than we could probably pass along in an hour, including don't underestimate all those free resources. So
They're
that's
great.
there. And people can email me at andy@loftgrowthpartners.com.
All right. Well, thanks again for coming on. All right, Tracy, the big finish.
Absolutely. Andy, you were great. Such great advice. I know that our audience is just going to love listening to this and looking forward to seeing you out in Anaheim next week. But audience, thanks for joining us. Thank you, Andy, and continue to follow us on Spotify, on Apple Podcast, as well as our YouTube channel. We post every Tuesday on LinkedIn, and also check out our website, which is www.road2retail.com.
Good
Thanks
luck
again.
out there, folks.
Thanks, and I'll see you on Tuesday.